Good afternoon. My name is David Levinstein, executive producer at 103.9 LA News Radio, and I'm here with our portfolio repairman, Mr. Jan Haagen, certified financial planner, offices in New York, in Huntington, and in Northport. Phone number 631-425-1966, 425-1966, and the website tenhagen.com, Tenhagen. Many years of experience for us to benefit from. That's a correct statement, I would imagine.
I think so.
We're talking about reviews.
Right.
Okay. When people should sit with a certified financial planner and review their wills, review their statements, review their debits,
right.
Review everything. I mean, these things change yearly. No, these things change quarterly, monthly for some people.
Correct.
Right.
Right. And everyone says, oh, year-end review. Well, that's good if you do it, but it doesn't matter what time of year you do it.
Right.
And as you just said, we've got your qualified plans, your IRA, your 401k, you've got wills, credit cards, mortgages, investment choices.
Right.
So pick one a month. Yeah.
Right. Actually, that's true. A year-end review, if you wait to the end of the year to review, it's too late to make any appropriate changes in your lifestyle, your spending habits, your saving habits, right?
Yeah. I mean, you also want to do when you have what's we call a life change.
Right.
It's a birth, a death, a divorce, a marriage, anything that radically changes your life. You want to review your beneficiaries with your qualified plans.
Without hearing from your client, how often do you reach out to your clients?
I send them an email birthday card every single year.
Right.
I send out a letter at the holidays, the Christmas time, and I send by email a note every single week to them. And then quarterly I send a little, it's a cartoon kind of a video that talks about what happened the last quarter.
So you are continually reaching out to touch your clients.
Absolutely.
And this is on top of their monthly statements.
Oh, yeah.
Right. Yeah. So in addition to their monthly statements, which is always a reminder to stand in touch with you, you're reaching out for them on their birthday every week, every month, every quarter with something else.
Right.
Right.
Yeah.
And so you're never hiding from your clients. You are always 100% accessible to them.
No, I want to make sure they know I'm there for them when they need me.
Right.
One thing that just came to mind is with credit cards.
Yeah.
You get your statement every month.
Right.
Nobody looks at them. Take a look and carefully look at it, because you might find a charge for $4, $8, $7, something like that.
Yeah.
And you have no idea what it is. It's perhaps some fraud people trying to get to your account, and they'll say, hey, we put $5, $7 in this month, next month. They never paid attention to it, so hey, we can hit them for a big charge.
I read about this recently, where people are tapping into people's accounts, and they don't want to. They don't want to have a big charge. They don't want to, so that people don't close accounts. Knowing that people generally don't read their bills, they'll put a $4, $5 charge in there, and they're doing it on tens of thousands of people across this country, and they're making a little tiny bit of money from a lot of people. So, and it's supposed to like a big $500 charge or a $1,000 charge, which we will immediately notice, call our credit card company, stop the credit card, and therefore reversing the charge, and maybe these people get arrested. They have these little $2, $3, $4, $5 charges on there, which we will ignore. Well, we will look at it as some fee.
Yeah, but that money will add up to them over that.
Sure.
But the real purpose of their purpose is to find out if you're paying attention or not.
Right.
Because then they're going to slam you with big bills.
Right.
Right.
So after a while, when they realize this guy doesn't even look at their bill, then you get big. There's a lot of identity theft going on there.
Too much.
Have any of your clients been a victim of that?
I've had a couple, but not many.
Right.
I try to drum into their heads, take a look, don't throw it.
Right.
One of my ex-wives, I've had two.
Right. Okay.
not half a dozen, but
let's talk about qualified plans review. I think it's important that people look at the qualified plans, but not so much as to keep reallocating their investments, but look at it to make sure what?
Make sure it's doing what you want it to do.
Right.
Make sure that it is at least keeping up with the indexes, the S&P 500, et cetera. And going along with that, if there's an investment in there that's down, and you sit there every month grinding your teeth saying, God, I wish this thing would go up so I can get rid of it.
Right.
Ask yourself this. if I did not own that position now, would I buy it? And if I'm not going to buy it, then take the loss. Losses aren't a bad thing. You get to write them off. And not in a qualified plan, but in a personal account. And then find something that you feel is better positioned to go forward.
Well, I always look at it this way. If someone bought a stock at $50 a share, and the stock goes down to $30 a share, and you say, well, I just lost $20. You did lose $20 if you sell that stock and buy another one that costs you $50 a share. But if you buy another, if you reallocated the investment to an equity or investment that's of equal value, so you went from 50 to 30 of your original investment, you sell the 30, you buy something else that's $30 a share that you figure that's growth. Though it is a loss on paper, psychologically I'm saying, well, I'm just, I'm taking what's down and moving into something of equal value.
Well, if it's down from 50 to 30, that's a 40% loss. Yeah. So I think it's time to reevaluate, is this a proper investment or not?
Is this something I would buy now? If it is, buy more, no?
Exactly. If it's something you like long-term and the company is solid, has good service, good products, whatever it is they offer, stay with it and perhaps buy more because you're buying at a discount.
Right. If you invest monthly and your dollar cost average and you bought something at 50, now it's $30 a share, it's a 40% discount, and you keep buying it, you're buying 40% more shares with your dollars.
Right.
And then by the time it reaches back to the price of $50 a share, you would not have just broken even, but you will have made money.
You will be net ahead of where you were.
Right.
A dollar cost averaging is what you do when you enter your 401k.
Right.
Every paycheck, you're buying X amount of money.
A little higher, a little lower.
Exactly.
Right. But people should probably take that path. A 401k investment forces you to be disciplined with your investment approach, because it goes every month. It goes into the mutual funds that you've selected and allocated for your portfolio. But let me ask you a question about allocation in review. Let's say, and I'm going to break it down very simply. Let's say an allocation is 25% bonds, 25% small cap stocks, 25% mid cap, 25% large cap, right? So you have 25%. And then one of those asset classes does very, very well. Right. And then when you look at the end of the quarter or or half a year or the end of the year, you started with 25% of all those four asset classes, and now it's out of whack, right? Because some of them outperformed than others. Do you reallocate and go back to your initial allocation of 25% each?
It depends on what your goal is going forward from that period of time.
Let's say your goal hasn't changed because it's only been like a year, and you're still investing for the long run.
Well, you mentioned
you take some off the winners and put them on the losers.
You mentioned small, mid cap, large cap. Etc.
Yeah, I was just giving it as an example.
But you didn't say domestic and international.
I did not know,
because it's a world investment arena now.
A lot of stocks are multinational companies.
Very much so.
Yeah.
Coca-Cola makes, I think it's over 80% of their income from overseas, not in the United States.
Well, look how big the United States is, and look how big China is, and look how and all of Europe, and yeah.
And there are emerging Asia, markets. There's all kinds of areas outside the U.S. You can make a lot of money over time. So get proper diversification. There's a thing called a Callahan chart, and it takes all the different types of investments and puts them categorically from top to bottom.
Right.
And we did a test one time, and we said, okay, we're going to buy the winners every year. So at the end of the year, what was the best segment? And we put 10 grand in. And the next year, 10 and 10 and 10.
So this is like a back test.
Yeah. Okay. So for 20 years, you bought the winners. Yet at the same time, there's a loser. Who's the one that was the worst performer?
And you bought those.
You bought 10,000.
So which did better at the end?
Wait.
I can't wait to find out.
You got the winners, you got the losers, and it's like let's catch up. It's so low, it's got to go back.
Right.
Or we take that what was total of 200,000, divide it equally amongst the different categories, and let it just ride in on them.
Okay.
So it's 200,000 invested over a 20-year period. The winners got you about 640,000.
From 200.
Which isn't bad.
Over 20 years.
But the losers got you about 840.
Okay.
And just dividing it amongst all the categories is over $1 million.
Wow.
So diversify, stay with the quality, because you'll see the last 5 years commodities have done very poorly.
Right.
but there's going to be a time where they're going to do great. So if you have,
do they have a negative correlation to the equity market?
Not necessarily, not today, no.
A lot of people think that.
They do, but you get an equity, which is corn or coal or whatever it may be.
Right.
People are going to buy it at one point, and they're not going to buy it another time.
Right.
So
it doesn't necessarily have anything to do with the market. People say the stock markets. I mean, it seems that gold and the equity markets do have a negative correlation with one another.
Yeah, because everyone runs to gold when there's a crisis. But my younger brother bought gold, I think it was back in the late 70s or so.
Right.
And he was so happy. He bought it at like 600. It went to 1,000. This is great. He still holds it today.
Right.
It's $1,300 after 30, 40 years.
Let's take a break. My name is David Levinstein. I'm speaking with the portfolio repairman, Jan Tenhagen from the Tenhagen Financial Group. His website is tenhagen.com, TENHAAGEN, TENHAAGEN. He is a certified financial planner with offices in Huntington and Northport and Manhattan. I urge you to call him for all of your investment questions. Be right back after these words.